Oh, there's so many yummy vegetarian options out there. You could try like lentil soup, veggie burgers, tofu stir fry. The possibilities are endless. Welcome, everyone. Today, we're going to dive into a critical decision that every Canadian company faces when they think about expanding abroad. And that is, what's the best way to structure those foreign operations? As we're about to see, the choice you make here can have a massive impact on your bottom line. And it really all boils down to the tax implications. So here's our roadmap for this analysis. First, we'll look at the fundamental choice you're facing. Then, we'll dig into the mechanics of one of those choices, the foreign subsidiary. After that, and this is where it gets really interesting, we'll run through a case study with some hard numbers to see how different tax rates can completely change the game. And we'll finish up by drawing our strategic verdict. All right, so let's jump right in. The first decision you've got to make is about the structure itself. You really have two main paths. You can set up what's called a foreign branch. Think of this as just an extension of your Canadian company operating in another country. Or you can create a foreign subsidiary, which is a completely separate legal entity. And believe me, the tax consequences of these two choices are worlds apart. So what's the big difference? Well, it all comes down to one word: timing. With a branch structure, any profit you earn overseas gets taxed here in Canada immediately, right away. But with a subsidiary, it's a different story. Those profits are taxed in the foreign country first, of course, but the Canadian tax is deferred. It's not payable until you actually decide to bring that money back home. And that ability to defer Canadian tax, well, that's a massive strategic advantage, as you can imagine. Okay, so let's focus in on that subsidiary option for a minute, because the way it's taxed is, well, it's a bit more complex. You're not just looking at a single tax event. It's really a multi-layered process. So let's follow the money, shall we? Here's how it works with a subsidiary. Step 1, your subsidiary earns a profit and the host country taxes it. Simple enough. But then, step 2, you decide to send that after-tax profit back to the parent company and Canada as a dividend. Well, the foreign country might tax it again through what's called a withholding tax. And then finally, step 3, the parent company in Canada distributes those profits to its individual shareholders and, you guessed it, there's a third layer of tax right here at home.
This brings us to a key concept here, and that's the term repatriation. It sounds technical, but all it really means is the act of bringing those profits earned abroad back home to Canada. And why is this so important? Because that act of repatriation is the trigger. It's the event that causes that second layer of tax, the withholding tax, to be levied.
Okay, theory is one thing, but let's make this tangible. Let's put some numbers on the table with a case study. We're going to start with a simple premise. Our Canadian company earns $1,000 of profit in a foreign country. Now, for our assumptions, we'll use a Canadian corporate tax rate of 27%, and we'll assume the final tax rate on dividends for individual shareholders is 50%. The real variable here is the foreign country's tax rate, and we're going to see what happens to that $1,000 under two very different scenarios. All right, this table here is really the heart of our analysis. What we're doing is a side-by-side comparison of the branch versus the corporation, or subsidiary, structure. And we're doing it under two distinct scenarios. First, a low foreign tax environment of 20%, and second, a high foreign tax environment of 40%. So let's really dig into these numbers and see how the strategic choice changes depending on the environment. Okay, let's begin with scenario number 1, the low tax jurisdiction. Imagine we're operating in a country with a corporate tax rate of just 20%. Now, that's significantly lower than Canada's 27% rate, and that differential is absolutely key. We'll also assume there's a 5% withholding tax on any dividends that get sent back home to Canada. Right off the bat, you can see the initial cash flow advantage of the subsidiary structure. Look, with a branch, that $1,000 in profit is immediately subject to the 27% Canadian rate. So, boom, $270 is paid in tax. But with a subsidiary, you're only paying the local 20% foreign tax initially. That's only $200. This means you've got an extra $70 in your pocket right there in the foreign country, ready to be reinvested to grow the business. And this chart really drives the point home. The subsidiary structure leaves you with $800 available for reinvestment abroad. The branch structure? Only $730. Now, if your primary goal is rapid expansion in that foreign market, that difference in available capital, all thanks to tax deferral, is a very, very big deal. But what about the end of the day, after all taxes have been paid and the money is in the shareholders' hands? Well, we need to look at what we call the total tax leakage. And even here, the subsidiary comes out on top.
The total tax hit is $506 for an effective tax rate of 51%. Compare that to the branch, which has a total tax bill of $526, or a 53% rate. The conclusion is clear. In a low-tax jurisdiction, the subsidiary is the more tax-efficient structure. Okay, now for part 2 of our case study. Let's completely flip the script. What happens if we're operating in a high-tax country? Let's say the foreign rate is 40%, which is now substantially higher than our 27% rate here in Canada. As you're about to see, the entire strategic calculation gets turned on its head. This is where that little 5% dividend withholding tax becomes a major player. Think about it. With the subsidiary, after you pay the $400 in foreign corporate tax, you've got $600 left. But the moment you try to repatriate that $600, you get hit with an additional 5% withholding tax. That's another $30. It's an extra layer of tax that simply does not exist in the branch structure.
So let's compare the total tax cost just to get the money back to the parent company in Canada. For the branch, because the 40% foreign rate is higher than Canada's 27% rate, you get a full foreign tax credit. That means no additional Canadian tax is due. Your total corporate tax is just the $400 paid abroad. But for the subsidiary, you've paid that same $400 in foreign tax, plus you've got that extra $30 withholding tax. The total is $430. All of a sudden, the subsidiary structure is the more costly option at the corporate level. And when we carry that all the way through to the shareholder, the final numbers tell the story. The total effective tax rate for the subsidiary ends up being 63%. That's now worse than the branch structure, which comes in at 61%. It's that combination, the high initial foreign tax plus that extra withholding tax, that makes the subsidiary the less efficient choice in this high-tax environment. So where does this leave us? After running through both of those scenarios, what is the ultimate strategic verdict here?
Well, the classic answer in tax is it depends, and it really does. There is no single right answer. But we can establish a very clear decision framework. When the foreign tax rates are low compared to Canada, a subsidiary is generally preferable. Why? It maximizes your funds for foreign reinvestment and ultimately provides a higher after-tax return. But when those foreign tax rates are high compared to Canada, the branch structure tends to be the winner. It allows you to avoid that dividend withholding tax and results in a lower overall effective tax rate.
Now, it is absolutely critical to remember, as our source material wisely notes, that this decision is not just a tax-driven numbers game. Not at all. There are crucial non-tax issues to consider: business factors, legal considerations, and so on. For instance, a subsidiary is a separate legal entity that provides a liability shield, insulating the Canadian parent company from risks in the foreign jurisdiction. You absolutely have to weigh these qualitative factors alongside the quantitative tax analysis. And that brings us to our final, thought-provoking question. The numbers tell us very clearly that in a high-tax jurisdiction, the branch is the more tax-efficient choice. But what if that same high-tax country also has a notoriously litigious business environment? Could that critical legal factor compel you to choose the subsidiary, the less tax-efficient structure, simply to gain that corporate veil of protection? It's a perfect example of why the best strategic decisions always require a careful balance between the quantitative analysis and sound qualitative business judgment.